Magnificent Seven stocks, what should we expect? It's a good question. Let's go to the first slide. MAG7, what should we expect? Stocks with high implied volatility. This is a little bit heavy, so bear with me on this. Stocks with high implied volatility can be tough to trade because of their extreme price moves, and their implied volatilities tend to linger at high levels for extended periods of time. We're talking about the MAG7 as being NVIDIA, Tesla, Meta, Amazon, Google, Apple, and Microsoft. The MAG7 implied volatilities trade between 25 and 75% the majority of the time. That's just their implied volatilities. Now, generally, stocks with extremely high volatility can be tough to trade, but not these stocks because they have a ton of volume. When you have a lot of volume, they're a little easier to trade. So, but if we trade these MAG7 stocks, what are some of the things to be aware of that may be different to trading something like an equity ETF, a sector ETF, or the SPY, or the SPX, or whatever else, the Qs? Specifically, how do the Magnificent Seven stocks differ from the SPYs and the big index ETFs when it comes to their implied volatilities, their historical volatilities, and their price relationships with implied volatility?
I would have no way, I have no guess. I wouldn't know. It's a great study. I don't think I've ever looked at it like this.
Okay, let's take a look.
Have you? Would you think about this or?
I've never really thought much about this. I mean, I don't do vol arb, so I never really thought. But so we looked at these seven stocks and the S&Ps, 2016 to present. We looked at the implied volatility, the historical volatility, that's what HV is, and price. We observed the difference between implied volatility and historical volatility. Implied just being what's expected to happen in the future, historical being what actually happened. And then we looked at the correlation between price and implied volatility. First thing, implied versus historical volatility. That spread shows us how much was a stock's implied volatility over or understated relative to the price volatility observed. And then we saw down below, which I'm going to go through in a minute, that implied volatility overstated historical volatility between 60 and 80% of the time, depending on the underlying. So right around the average of 70, which wouldn't surprise any of us. If we had to pick a number, that's where we would pick. When we look at the spread, the average implied to historical, the overstatement in the SPY was about 80%. Okay, the overstatement in NVIDIA, 61. The overstatement in Tesla, 73. Meta, 67. Amazon, 75. Microsoft, 74. Google, obviously, 68. And Apple, 73. Now, what's interesting about this is the one with the lowest implied volatility, the SPY, has the highest, is overstated the most amount of time, which would kind of make sense in this entire process, okay? Because it's the most diversified. That starts with the lowest number, so you make the least amount of money. And then you look at the spread between those two, and it has roughly the largest spread. It's not, I mean, Tesla, you can argue Tesla's been higher, and Amazon, Apple occasionally, but you know, all right, let's just say it's mixed. But the IV overstatement rate in the SPY is higher than everywhere else. But the other stocks, you make more money because they have higher implied volatilities. So you take more risk, you make more money. Let's go to the next slide. The trade-off of the higher implied volatility is that you get a lower percent that implied volatility is overstated. That means choppier P&L and larger losses. Despite SPY being the lowest IV underlying, its overstatement rate was the highest and its average premium over historical volatility was the highest. That's exactly what we said just a minute ago. So when you look here at this relationship, the average implied volatility premium over historical in the SPY is huge compared to everything else. Now you're thinking to yourself, with that huge premium of implied over historical, with the IV overstatement rate so high, then why would I ever trade anything else?
That's a great question.
Okay, because seriously, that's the question that when people see this slide, that's what they go. And the answer is because in NVIDIA, you get, and in Tesla, the average IV is 64. So you get over 3 times the credit. Like you make 3 times more money when you're right. In NVIDIA, you make 2.5 times as much money. In Meta, you make 2 times. In Amazon, you make 2 times. In Google, you make 1.5. In Microsoft, 1.5. And in Apple, 1.5. The answer is because you make more money. But what about the correlations between price and implied volatility? Do higher implied volatility underlyings have a different relationship between their price and implied volatility compared to lower IV underlyings? What do you think about this?
Oof. I don't think they can have a different relationship, but the magnitude of the move obviously has to be higher. I mean, I think there has to be more occurrences for volatility to contract only because it's starting from a higher number.
Do higher implied volatility underlyings have a different relationship between their price and implied volatility compared to lower implied volatility underlyings? And of course, here I would argue that, yeah, they have a different relationship. Higher implied volatility underlyings between their price and IV compared to lower, I mean, you're going to have a lot more opportunity. You're going to want to trade the underlyings with the highest implied volatility. The high flyers that had the highest implied volatility in green also had the weakest price to implied volatility correlation. Additionally, highest implied volatility stocks occasionally saw periods of positive price IV correlation, whereas the lower IV stocks almost never did. You know, again, when you look at the stocks with the highest implied volatility, the correlation and the percent of time that they are positively correlated, yeah, you have the most opportunity with the stocks with the highest implied volatility. You also take the most risk.
Yeah, well, I mean, that's the risk versus reward, and that's why you're going to look for high implied volatility to sell.
You take the most risk and you have the most opportunity.
I mean, look at NVIDIA just from a standpoint of, you know, zooming in from, because it was earnings yesterday. I mean, you had a $14 expected move. It certainly could have moved twice that. We've seen earnings trades where they moved twice that easily, but it didn't this time. And volatility contracted a lot, and you were able to make good money selling volatility.
Let's go to the next slide.
Reward.
So some of the takeaways. When trading stocks with higher implied volatilities, we notice the following differences when compared to trading in a low implied volatility underlying like the SPY. Implied volatility will understate actual price volatility more frequently. This is interesting. Implied volatility will understate actual price volatility more frequently. The amount of IV overstatement could be razor thin. Implied volatility will have a weaker average correlation between price, and implied volatility will see seasons of positive and negative correlations with price. This is when trading stocks with higher implied volatilities, as opposed to trading low volatility underlying like the SPY. Higher implied volatility underlyings will understate actual price volatility more frequently. That's
the key to.
You would expect that. You're taking more risk.
Yep.
The amount of IV overstatement could be razor thin. You are taking more risk. IV will have a weaker average correlation to price. You are taking more risk because you make more money in all these cases. And implied volatility will see seasons of positive and negative correlation with price, again, because you're taking more risk. These characteristics of high implied volatility imply that it may take a long time to realize consistent P&Ls. That's why you're going to be a little more all over the place. The argument here from the research team is stay extra small in higher IV underlyings.